Thank you, Tim. Thanks all for joining us. I have with me Coleen Barbeau from Franklin Templeton Global Growth Fund and Andrew Norris from Lazard Global Thematic Fund. I think there's a lot of interest in this session today. We've heard a lot of sessions about disruption and innovation and uncertainty, so it will be great to get your global insights, particularly with what's happening on global markets, sort of how you're positioned and the outlook from here. Firstly, as we've had with a number of these sessions, we're doing live polling just to gauge your current positioning and sentiment towards global equity markets. So if you could turn to your poll now. We've polled this every year, what my clients' growth asset allocation, their preferred exposure is to, whether it be global equities, whether you're neutral between global and Aussie equities, whether it's Aussie equities or property and infrastructure. This was the 2015 result. Obviously, global equities was a high proportion. 2016, we saw sort of a bit more neutrality between Aussie equities and global. And if we look at sort of total FUM asset allocation just in the market, it's at the end of 2016, people broadly equally balanced between global and international equities in Australia. So if we can bring up the results for today, we can see again, global equities probably getting back a bit of share in the Australian market. Still some neutral, and pure Aussie equities is sort of a bit of a distant third there. The next poll question. My primary concern with global investing is impact of currency, lower income levels, relevant for franking in Australia, past performance of global equities, and lack of familiarity. Historically, currency has been the biggest concern, and then that sort of income level. And again, that's been pretty consistent over the years. If we can see the results, this year, again, pretty consistent concerns year to year. And then thirdly, poll question, if we can go back to that. It's not on the screen. Here we go. I prefer my clients' currency exposure to be unhedged, actively managed, a blend of unhedged and hedged, or hedged. Historically, there's been a preference for unhedged, and probably a bit more trend towards a blend of hedged and unhedged. And if we go to the current results, we're looking similar to last year. So I think there's probably a bit more actively managed and blending going on than historically purely unhedged exposure. And then from here, just on the outlook, maybe this will change at the end of this session, but my clients' exposure to global equities is likely to increase, remain the same, or decrease over the next 12 months from here. Sort of 2 years ago, the market was probably pretty bullish on global equities. And I think a year ago, maybe people thought global equities were a bit toppy, and were sort of keeping their allocation constant. And if we go to this year's, again, people seem fairly comfortable with their allocations, but that may change by the end of this session. So I guess, and that's the results that we've just seen. So I guess in just what we've been talking about today, we've had quite a year of big geopolitical events and market dislocations. In 2016, we had Brexit, and we had the US elections. While volatility on a VIX measured basis is low, we've seen sort of big reversals in trends. We've seen value come back into favour. We've seen sort of a big rally in sort of more cyclical stocks in the last quarter of 2016, post-Trump and this reflation rally. So I'd just like to firstly get the perspective of two fundamental managers just on their core philosophy for investing through the cycle, in an environment of sort of heightened uncertainty, and so how you look to build a portfolio for the long term. So Coleen, perhaps if you could give us a view of your overarching philosophy to investing.
Sure. So for us, what we definitely do not do is try to manage to any of the economic or geopolitical risks that we see out there on the landscape, because we kind of view it as tail risk, risk that we can't really navigate or predict when it's going to happen. I mean, you look in just the last year alone in terms of Brexit and the election of President Trump in the States. I don't think there were many people that forecast either of those events to happen. And the outcome in terms of the markets was relatively fleeting. I mean, the Brexit experience pretty much reversed itself in pretty short order following Trump's election. It was a difficult fourth quarter for sure, because it was a fairly narrow advance, but by the time we got to this year, and certainly through the first 4 months of the year, that trade completely reversed itself. Rather, what we do is really stay focused on the bottom up. We're basically just looking for great companies that have sustainable business models, that are generating sufficient free cash flow to reinvest in those businesses for a growth trajectory going forward. I think an important component of what we do is we definitely are navigating down the cap spectrum, trying to find companies earlier in their growth phase so that we can own them for the long term and capitalize on the growth trajectory that they're going through. And so our average position holdings are going to be, I guess on average, somewhere between 4 to 5 years, but it's not unusual in our portfolio to hold companies in excess of 8, 9, even 10 years. So that's our general philosophy in terms of the macro, the geopolitical, and what we do from a bottom-up fundamental perspective.
Andrew, I understand you sort of have an additional overlay of a thematic analysis to long-term investing. Could you touch on that in your philosophy?
Well, our approach is that if you're an equity investor, what you're really interested in is wealth creation, because that's what equity is for. And wealth creation is an extremely long-term process. So it takes companies a long time to invest in new products, discover new drugs, and to bring those to market. So essentially, the way we have to think about the short term is only in terms of how it might create punctual or short-term risks to the portfolio, which we may have to pay attention to. But it doesn't change that overall fundamental long-term approach. So let me make a few comments on the long-term approach. And as I said, we're fundamental investors. We exploit wealth creation in driving returns. That means that we don't exploit rent-seeking. What we mean by rent-seeking is companies borrowing money to buy back shares and not indulging in capex. That's actually wealth destruction, because the capital stock will age and returns will fade. So we focus, as I say, on wealth creation in the long run. Well, how do we do this? And we're thematic investors, as many of you know. And thematic is a very broad term which doesn't actually really tell you much about how we invest. What we believe is that in a portfolio, you have to have context. If you don't have context, if you just put a portfolio together of your 50 or 100 favorite stocks, you can build in all sorts of unintended risk concentrations. We also don't believe that the benchmark provides context, because, knowing that Rio is an Aussie company doesn't tell you anything about the risk or the opportunity that it represents. And industry sectors are equally inefficient. They don't provide information. So what we do is to use company analysis in order to find where companies are telling us that they are changing their business models, how they're competing over the long term to deal with secular and structural change. And this is where we think we find opportunities. We're not as interested in short-term cyclical matters. That's very well covered, and it's hard to find an advantage. So what we're looking for is a series of what we call risk and opportunity sets. And what we mean by risk and opportunity sets is an investment asymmetry. Heads we win, tails we don't lose. We don't use, for example, standard categories such as growth or value. You can find asymmetry in both these headings. So how do we think about risk to finish off now? Well, first of all, it's the diversification of these risk and opportunity sets. That's a very simple tool. If they are distinct risk and opportunity sets, then we will have diversified the portfolio. But then with respect to punctual risks, which is your question is about, what we do is to take considerable care when we think about the downside. We try to avoid capital losses. And what we do here is to try specifically to avoid capital misallocations in the market or where capital has crowded. I mean, a great example of this would be avoiding financials in the lead up to the global financial crisis. Now, we happen to think that there's a big capital misallocation in markets today, which is probably more important than political developments, even though those are considerable friction in markets. And that concentration we call peak short term. It's the prevalence of opportunity models and risk models, which essentially all make the same assumptions and which have, because of quantitative easing, driven investors to shorter and shorter time horizons.
Actually, can I add something to my
Sure.
answer? I forgot to mention that, and you reminded me, the way that we manage risk in the portfolio is a little bit unique. It's making sure that in building the portfolio and coming up with these sustainable businesses that we're not duplicating the economic drivers that drive the earning streams of the companies that we own. So for example, when you look at the fourth quarter of last year post the Trump election, the best performing sector by far was the financial sector because one of the big campaign issues he ran on was deregulation for the financial industry. And so you had a huge run in the banks. In our portfolio, you would never see us owning a big basket of US banks, but rather we would seek to find the kind of the best of breed opportunity for us. And so it's diversifying that way, not taking a, kind of a sector or relying on the benchmark to determine where you want to be in regions, but rather building it from the bottom up and making sure that you're not getting big clumps in any one economic driver across the portfolio.
Coleen, perhaps given where we are in the cycle, we've had sort of a low interest rate environment for an extended period of time, low growth world as we've heard today, and investors sort of piling into quality stocks. How do you see the opportunity set for you as a long-term investor when valuations could arguably, be seen as stretched? So does that reduce your opportunity set, or are you investing through the cycle and growth will basically overwhelm that valuation consideration?
Yeah, so we are investing for the long term. I mean, we actually have looked at a cyclically adjusted chart of PEs going back to 1980 and broken them out by regions. And basically what it tells you is that we are bumping up against the high of the average of where the markets have been. And from a regional perspective, leading that, not surprisingly, is the US. And then kind of lagging at the bottom is emerging markets. I do think that looking at the US in particular, you've had a couple of things going on over the past, particularly 3 years, in terms of the fact that there's been, well, longer than 3 years, there's been this enormous liquidity pumped into the system. You have had, historically low interest rates. You've had a very strong currency in the US. And because of all that liquidity and because of the interest rates and the strength of the currency, investors have been looking for a home for their assets. And that has resulted in a fair degree of flows into passive. And I think that the flows into passive have created a situation within the US market that perhaps has pushed, the upper cap band of the market more than perhaps the space that we look for opportunity sets in. And so, to be honest with you, across regions, including the US, we are still finding ideas that are reasonable. I'm not going to say valuations aren't higher than where they were 3 or 5 years ago, but we still are finding ideas in the marketplace.
Andrew, perhaps how do you think about valuations in this market?
Well, I said earlier that we don't think that either growth or value is an adequate way of defining the world. So you can find opportunities under both headings most of the time. And there are obviously value traps or growth stocks. Amazon was mentioned frequently in the previous presentation, which is very hard to value, but which clearly have very attractive optionality. So I think if you're a long-term investor, what you have to do is to look through the cycle. But one point I would make about valuations at the moment, and that is that if we look at the conjuncture in financial markets as a whole, we are at a very interesting starting point, and every day is a new starting point, where debt levels are high, where, that's a very important point, where interest rates are extremely low, and where valuations, as Coleen has said, compared to history, are pretty high. So that is a demanding starting point, and I think that any program has to pay attention to that.
Perhaps we can talk about, we've talked about technological disruption today and innovation quite a lot. I guess from the context of Australian investors, we have quite a concentrated market. We've got big exposure to the financial services sector and also the commodities and resources sector. I guess you have a bigger opportunity set globally. How do you see the opportunity for owning the disruptors in the market and avoiding those that will be disrupted? I'm just interested in your portfolio positioning and opportunities you're seeing there.
Yeah, it's interesting. Technology is impacting everywhere, right? And so I do think that in the companies you own, you definitely want to make sure that they're embracing the opportunity that technology brings to the table in terms of enhancing their business. So, I think of a couple of examples in our portfolio. We own a company called Tall Education, which is a Chinese tutoring company, basically servicing grades K through 12. And the way that they've basically embedded technology to stay in front of the competition in their industry is, number one, the use of social media, portals, chat rooms to figure out where there's demand for tutoring services across China and where they should be establishing centers. In addition to that, when you think about the typical learning experience, it's kind of linear in fashion, right? So historically, there's been a teacher or an instructor at the front of the room, there's been a student sitting across. And today, with technology and the opportunity to live stream, what they've been able to do is to have centers in the primary cities, places like Beijing and Shanghai, provide live feeding into that, and then promote that out to Tier 2 and Tier 3 cities. So instead of providing pre-recorded programs, they have the ability to provide live streaming, which they can charge a higher fee for, at the same time expanding their reach broader into the country. And then finally, they have the ability to have apps and learning modules that they can put out there to basically support their tutoring programs, all of which filters through to better assessments for them and increased ratings and reputation. And so kind of maintaining that edge over the competition. It's not anything that's lightning on fire in terms of technology, but it's definitely utilizing technology to stay ahead of the curve. Another example in our portfolios is this company we own, Just Eat, and I don't know if any of you guys use Menulog, but they acquired Menulog not long ago. And so what basically their business model is providing a payment and ordering system that sits between the consumer and the restaurant. And so basically, as a consumer, through their partnerships with companies like Microsoft and Apple and Amazon and Facebook, you can put your food order through your gaming system, your laptop, an app, whatever it is you chose to do, your desktop, and then it goes directly through to a terminal at the restaurant, which they provide, and the restaurant has the benefit of getting all of the payment done for them, seeing the order, but in addition to that, they provided added services that allow the restaurant to see sort of what their reorders have been, what the experience has been from a rating perspective. It just enhances their ability to make the service better. And so, I think that there's technology everywhere. I think the way to deal with it is to embrace it, to make sure that you're staying ahead of the competition and making your product, rational and competitive in the marketplace.
And when you see these opportunities, how are they priced? Are you getting in at reasonable valuations, or are these sort of disruptive opportunities something you have to pay up for and not look at traditional metrics of valuation?
No, I mean, you never make money by paying too much for the companies you buy. Yeah. So you really do want to try to make sure that you're buying at a reasonable valuation. And, for example, Tall Education, we've owned for the better part of 4 years, and definitely got in a reasonable valuation. And if a company's executing properly and they're young when you bought it, the earnings roll over with you every year. And so there's a trajectory ahead of you as long as they're investing for their growth. And so I would say that we are definitely cognizant of the price that we're paying. We're not using price targets to get in or to get out, but rather making sure that we're in rational space in terms of what the valuation is. And so we utilize a DCF for our valuation. We calculate a base case assumption, but then we do kind of sensitivity around that to make sure that what the downside is not overwhelming what the upside optionality is. Sure. And so that's how we approach valuation.
And Andrew, in your sort of thematic approach, how are you seeing disruptive technology? What sort of themes are you looking at, and how are you playing that?
Well, technology is absolutely essential for wealth creation. That's the history of the world. But remember, it also brings with it wealth disruption, or wealth destruction, sorry. And I think the point to make here is that as new technologies emerge, it's often much easier to identify the losers than it is the winners. When any new industry emerges, there are multiple participants, it's chaotic, and picking the winners, frankly, is extremely difficult. So let's start with wealth disruption, or rather industry disruption. I heard that Amazon, for example, we're mentioning it again, has arrived here in Australia. Well, the one thing you know is that you don't want to own Woolworths or Coles, because look at what's happened in America. The conventional retailing industry is being gutted at the moment. It's an absolutely dramatic downturn. And your retailing industry is pretty tough here anyway. So that's a very easy example of an investment that you should avoid. We think a lot, for example, changing the subject, about personal transportation, so autonomous driving and electric vehicles. Those two things sort of go hand in hand. Well, who knows who the winners will be? But you do know who the losers are going to be. The existing auto manufacturers are going to fight to the death to defend their position in their industries. And it's not clear at all that they have the necessary skills to succeed in the future. Someone told me the other day that an electric vehicle has 45 moving parts only. Well, think how many moving parts there are in a conventional gasoline-powered vehicle. That's not necessarily the right skill set. But you can expand the ecosystem even further. With autonomous driving, if we don't have accidents any longer, what about the insurers? With electric vehicles, what's your view on oil and gas in the long run? So you have to think first, in the first instance, about disruption. But if I turn to opportunities now, what I said a moment ago is that the disruptors, these industries are often chaotic. The promise is wonderful, but it's very difficult to pick winners. What we find is a more valid approach is to try and find where traditional industries are successfully adapting or embracing, as you put it, these new technologies. And we have 4 broad ideas in our portfolio, and they all come under the heading of what we would call information in systems. And information in systems simply means that companies have the ability to collect data from their products or from the consumers that they serve, turn that data into information, and to create a measurable value added. It cements relationships, it improves productivity, and so forth. And we have really 4 main headings here. One are very conventional capital goods industries. Rockwell Automation is a stock we have in the portfolio. I'm not going to go into detail on this stock, but they produce automated production lines. But what they've done is to embed sensors into the machines so that if the machine sends signals saying, well, I'm about to collapse, they've already got the technician out there. They've preempted the problem, and the production line can perform according to specification. That's a huge value added, but it cements Rockwell's relationship with its customer. That's a very traditional industry. Another might be new data businesses, which all rely on network effect. Network effect, of course, is the tendency to monopoly, because obviously the bigger a network is, the more valuable it is. These are very powerful business models. The trick, obviously, is understanding those which actually make money. Uber doesn't make money yet. It's a big disruptor, and it's a network business. So these are the choices that you have to make. We obviously own Google. It makes a lot of money. It's not even a particularly expensive stock. But maybe a better example, something which is not so much in the highlights, would be a company called WorldPay, which we acquired recently. WorldPay is a merchant acquirer. And what they do, they have about 400,000 merchants who use their platform, and they allow those merchants to collect payments from their customers in about 300 different ways, either in the physical world, customers walk into the shop, or in the internet. Now, that's hugely useful to those merchants. And obviously, the bigger WorldPay's network is, the more valuable it is, the more utility there is to the merchants who use it and the consumers who are paying those merchants. Now, that's a stock which IPO'd just over a year and a half ago. It was in private equity. It came out of a bunch of banks in the UK as they were restructuring after the financial crisis. It's not a very expensive stock. So that's an interesting example. Software as a standard is another very interesting industry indeed, where software companies can create standards. They strengthen their relationship with the customer. What they also do is take away from the customer the need to make all of the decisions about what hardware do I buy, what operating system am I going to use, what applications should I put on my systems. So by getting control of all of those decisions, they've got a much stronger relationship with their customer. The customer, however, has a much better proposition. They get instant response, they get greater utility, and so forth. So Microsoft, another well-known stock, is a good example of this. As they're moving their business to a subscription model and developing the Azure cloud business alongside it, they're making this migration successfully. Another example here will be Checkpoint, which is the cybersecurity company. And you've all heard about the recent internet attacks, but this is a great example of an industry security standard which has precisely these relationships. The last example I will give is the consumer. And I'm not going to talk about Amazon again. I think we all know that one well enough. But the point about this disruption here is that what is created between the consumer goods company and the consumer is a direct relationship. Try not to use your imaginations here, but I went on holiday with my wife not long ago, and she said I needed a new swimsuit. So she directed me to a website, and the website said I could design my own. I mean, unbelievable, you know, and it wasn't a budgie snuggler, I promise you. Anyway, it's this interaction between the vendor and the customer which is so important, because what it does is to align customer desires and preferences with company decision-making. And I said Amazon's a great example, but another one, again a stock we've had in the portfolio a little while now, is a stock called Activision Blizzard. Activision Blizzard produce electronic games. Don't ask me which ones, because I'm too old to play them. But you know, it's an industry we've been interested in for a very long time, because more and more kids play them. Anybody who's got children knows how much time they spend on these games. What always troubled us with the investment in the past is that writing a new game or creating a new game is not systematic. You know, producing new movies is not systematic either. And so it's that lack of a systematic investment story which made them difficult for us. What's changed with these internet relations is that the users of the game now provide the inputs back to Activision Blizzard saying, well, this is where I want the game to go, or this is what I would like the ending to be. And different players can have different endings. So there's a feedback loop here, which is immensely powerful. At the same time, what Activision Blizzard is able to do is to sell in-game products. It can be bullets for your gun, or many, many different things. But the point here is that they've strengthened that commercial relationship in a very, very similar way. The last point, and I know I've given a long answer, so forgive me, that I'd make is that technology is a very seductive thing, and we all want to have as much of it as possible. But I think the challenge for a portfolio today is to keep that exposure overall limited. You know, we know who the disruptors are. We can have clear ideas where the opportunities lie, but don't let it become too big a part of your portfolio. And this is a current market observation. The S&P 500's advance so far this year has been entirely attributable to the 4 or 5 big stocks. They're called the FANGs. I'm sure you know them: Facebook, Amazon, Netflix, Google, and so forth. The rest of the market's done nothing. Those stocks represent 37% of the NASDAQ 100 index. This is a huge market concentration. So the investment problem isn't knowing that these standards and network businesses are powerful. The investment problem is being able to contain that exposure in your portfolio and do something else elsewhere in the portfolio.
Coleen, Andrew sort of touched on it's easier to find the companies that will be disrupted and avoid them. What are you avoiding in the portfolio now? What do you see as unattractive and has high risk?
I don't know that there's any one area or sector that we're avoiding from a risk perspective. I can tell you that where you won't find us is in regulated industries. So no exposure to utilities or telecom. We have a hard time finding growth in consumer staples. So we have for a long time been underweight to that part of the market. Interestingly, for a growth manager, we own materials names. It's not the deep cyclicals, but rather materials names that are further up the food chain, so to speak, in terms of bringing sort of a technology edge or a competitive edge to the market. So for example, in the material space for us, one of the names we own is this company called Umicore, which is a Belgian-based company, and it's got 3 lines of business. One of them is related to the roots of their business, which went all the way back to the late 1800s when they were just a mining company. And about 20 years ago, they had developed a technology which enabled them to take waste materials and be able to recycle them and extract out something like 19 different base and precious metals from that, and then sell those metals into the market. And so kind of a very niche business, not a lot of competition, definitely technology associated with it. The second thing that they're involved in is catalytic converters. This is not a new business. It's a clean technology type of investment. Basically, there's only 3 competitors in the space. It's themselves, Johnson Matthey, and BASF. High barriers to entry because there is technology associated with it, but there's also a lot of expense to developing that technology. And so no competition on the forefront outside of those 3 players. And the final part of what they do is they provide a component into rechargeable batteries. And so over the past many years, a big part of their earnings from that perspective was being driven by mobile devices and rechargeable batteries that were within. More recently, they've been selling more into the auto market, a topic that Andrew mentioned earlier in terms of electronic cars. So it's a business that's able to extract value out. It's got more kind of sustainability and consistency to its earnings stream, and yet it resides in the material space. And so it's kind of interesting. So as a growth manager, we're kind of overweight the material space, but it's sort of companies along that profile that we're investing in. In terms of a regional perspective, I can tell you that for our portfolio, we have an underweight to the US, which has been a long-standing position. It's at times been challenging over the past many years for many of the reasons I mentioned earlier. The US dollar has been strong. There has been a lot of performance out of the US market, but we've been able to ride through that. We have been overweight to Europe and the UK. We have struggled with finding opportunity in Japan. If you think about kind of what I described as the types of companies we look for, we're penetrating down the market cap spectrum, sustainable growth. Within the Japanese market, it's kind of hard to find sort of those niche entrepreneurial early phase companies because they're selling into the local market and there just isn't a lot of growth there. So that's always been kind of a perpetual underweight for us. We do have exposure to emerging markets. That's been pretty consistent over time. It's ranged anywhere from 5 to say 15% of our portfolio. Today we're somewhere around 10%. So that kind of gives you an idea of where we're finding ideas and where we're not finding ideas.
Andrew, I know Japan has been a bit of a theme for your portfolio historically, and also North America. You've got an overweight position, so could you talk about the counter argument to those observations?
Yes, I can. We don't actually think very much about geographical allocations at all. These are a residual of our other choices. I'll deal with Japan first. Our position in Japan is very small indeed. And the reason that it's very small is that Japan's extreme monetary policy, we think, is an extremely dangerous situation. Obviously, in the short run, Japanese exporters have done reasonably well as the Japanese yen has depreciated, but that's not really a long-term investment case in our mind. So the only residual exposure that we have in Japan today is 3 of the big real estate companies. And the reason for this, very simply, is that that extreme monetary policy could very well lead to inflation. And I think the only way you can really deal with inflation in Japan is through the ownership of real assets. So we have very limited exposure there. The more important topic is our overweight in the US. And this, as I say, is a consequence of other decisions. In my last answer, I spoke a lot about the technology opportunities that we see. And it's simply the case, in our opinion, that in the US, this is where you find the best expression of these new technology-related opportunities. So it's a natural consequence of looking at these industries and where they're adopting technology, which is not to say that it's not happening elsewhere in the world, but it is, in our opinion, the best place to look for those. And so what has happened over time as we've become more convinced in our information and systems ideas is that the exposure there has grown. What we do have, on the other hand, is overall a negative view on Europe. And that negative view on Europe relates entirely to Europe's structural challenges. We believe that the European Union is a fundamentally flawed concept. But the point is that for Europe to be competitive again, for France, for example, to be competitive again, they've got to get their costs down. Well, they can't devalue their currency because they don't have their own currency. So in France, you've got to imagine that French workers are going to be happy to earn less. I can't imagine that happening. The other side of the argument is that Germany controls all the purse strings in Europe, and this is Germans' mantra is fiscal responsibility. You know, look at the Greek crisis and how that's played out. So it seems to us that whatever the political evolution so far this year, and thankfully the extreme right isn't in power in any of these countries, although it's gained significant share of the vote, these structural problems in the long run create very big headwinds for Europe as a whole, which is not to say that we don't have some global European companies. We do. With respect to the emerging markets, if you'd like me to address the topic of the emerging markets, again, we have very little exposure today. Now, we're well aware that there is an argument which says today that in the emerging markets you get more growth and there is a value opportunity compared to the rest of the world. And that's true in the short run. But if you're a long-term investor, I think what you have to think about is the world's currency system. The world's currency system and China. These two are very related things. And what I mean by the world's currency system is the dollar-based system that's commonly called Bretton Woods II. The point here is that it's US financial conditions that set financial conditions for the rest of the world. So if interest rates in the US go up, that creates tighter financial conditions in the emerging markets. If the US current account deficit narrows, that creates tighter financial conditions in the emerging countries, simply because it's the American current account deficit that provides liquidity to the rest of the world. So interest rates may be going up in the States. The current administration is talking about protectionism. One of the points which was mentioned earlier was on the topic of currencies, but the point is that currency movements recently, when I say recently, in the last 2 or 3 years, have been very extreme, and that was in the answer to the poll questions here. But the point is that the stresses in the global economy, we think, are showing up in this currency system. There is an argument that says that China will take over from the US, certainly in Asia, maybe in the emerging markets as a whole. And the Chinese have been talking about the development bank that they've created and the provision of finance, renminbi finance, to the emerging countries. Well, that may happen. But I think there are a couple of important questions that you have to answer first. One is, China doesn't run a current account deficit. Where is the liquidity for the rest of the world coming from? And secondly, and I have no special insight here, China has a very big credit problem. Credit as a proportion of GDP is as high as it is in the States, for example. And that's built up very, very quickly indeed. Well, one thing I do believe is that if China is going to keep control of this credit situation, then they need to keep their capital account closed. So it's going to be very difficult for them to provide liquidity to the rest of the emerging markets and keep their capital account closed at the same time. Those two things are an anomaly. They're inconsistent with each other. So we have relatively low exposure to the emerging markets.
We are running out of time. I'll take one question from the screen that's come through. I think it was in relation to a comment Andrew made, but I'll get Coleen to answer it. The question is, the statement that owning Woolworths is a bad idea because Amazon is coming is a rather blunt statement. I guess at what point is that in the price, and when does a company may have structural challenges? When is it ever in the price? What's your view on that?
Well, I'm
just kidding.
Are you going to answer for me?
No, I was interested in Colleen's view first, and then it was
okay.
Andrew. Yep.
You know, okay, so I would say that, you know, I think Andrew's comment in talking about Woolworths with the competition of Amazon coming down the road is based on what we've seen. We've seen that train coming down the track in the US, and it's been pretty painful for many of the retailers, particularly those that are, you know, selling the product like Woolworths would be selling. Having said that, what you now see Walmart doing is fighting back. And I think that, you know, there is a way to exist alongside of Amazon, but it could very well take some time, and there could be an initial hit to the system. Not everyone gets run over by Amazon. You know, they have had first mover advantage in retail. We own an online retailer in Latin America, and Amazon tried to go in and compete with them and wasn't able to do it, and they backed out. And so, you know, being the incumbent, you know, I don't know, I'm not close enough to Woolworths to go into any more detail than that. You know, I think perhaps there is a chance, but for sure, it's a formidable competitor.
And Andrew, quickly?
Well, I should apologize for being flippant because I was trying to give a very simple example based obviously on the experience in the US. But I don't think it's right to underestimate the power of Amazon's business model. Walmart may be fighting back, as Coleen says, that's true. But what has happened to Walmart's margins? What are they having to do with their physical footprint? This is all coming at a very considerable cost. So at least in the short run, and who knows who will win the battle between Walmart and Amazon, this is not going to be great for their returns. And I'm sure it'll play out in a similar way here in Australia. But it's an obvious topic to be thinking about.
Well, Coleen, Andrew, it's great to get a global perspective on the investment challenges we face here in Australia, and that was a great insight and session. So if you join me in thanking Coleen and Andrew today.